Okay, good afternoon, everybody. Today is January 14th, 2022. It is 1:15 Pacific time, 4:15 Eastern. Market just closed 15 minutes ago. Weekly take on the market. I am your host, Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Here is the disclaimer. Take a moment to read this, please. Any stocks mentioned are not buy or sell recommendations. We are not licensed at IBD. We just provide research and education. Hopefully you are learning to do this on your own. Okay, so we'll get into the markets. We will talk about the indexes, etc. But there's a lot of talk about ARK and their ETFs, and rightfully so. They were the poster child for the bull market that I think, has come and gone. I think that this cycle, this bull market is over. There'll be a new cycle of leaders, which is good, and we just have to kind of be patient and wait for them. But it reminds me a lot of CGM Focus, which was the best fund of the decade in the 2000 to 2009 period. Ken Hebner was the manager, and he just knocked it out of the park. Very overweight home builders throughout the big building boom after the tech bubble. So you can see in 2000, his fund really started to take off. Rough patch in 02, 03, but then another really huge wave up. I'm fairly certain, if I recall, he did super well in Petrobras, which was the Brazilian state-owned oil and gas driller. So he just nailed it. He had this cycle perfectly, and was named the fund manager of the decade. And it's like the kiss of death. I remember in 2000, there were a lot of funds that were doing super well, like the Janus 20, and I think it was called the Jacobs Internet Fund. And the money just, when they're small and nimble, and they're in undiscovered areas, they can run up and create really good performance, and then that really good performance just piles in at the top, unfortunately. And some people get in the middle ground, right? It's not that smooth. There's money coming in all the way, but as a general rule, the average person, the average dollar invested in these funds loses because they're chasing performance. So his fund hasn't come back since. You can see it topped around 60 in late 07, early 08, and just has not performed ever since. Ken Hebner is smart as a tack, knows markets inside and out, but for whatever reason, he's just not in the right stuff, and that's just kind of what happens, unfortunately. So you go to currently, and I saw this about ARK 11 months ago, was outperforming the NASDAQ 100 by 430%. Now it's up 10% since inception. And unfortunately, I think they've calculated that the average dollar invested in ARK is a loser, because at the lows, this is a side-by-side comparison of ARK, and maybe we'll pull it up, but I think in 2017, I read that ARK had 17 million in AUM, assets under management, and at one point probably had 17 billion. Right up here after it had gone up tenfold. There's a great quote. I was listening to a podcast. It's people tend to buy what they want and sell what they need in the stock market. So higher prices generally brings the stock market's the craziest, most hard to understand auction marketplace in the world, because for the average person, and even for me, it's like if I go to the store, my favorite foods are cheap, I buy more of them, barring spoilage, of course. And if they're expensive, I buy less or I look for substitutes. But in the stock market, it's the one place where higher prices, buyers live higher and sellers live lower. You have to really understand that message in the stock market, that there are buyers at higher prices for stocks, including myself. There are stocks that I want to buy and I won't buy them until they show me higher prices. And every higher price tends to bring in more buyers until it finally ends, but that can go on for a long, long time. And every lower price tends to bring in more sellers because it just creates more people. Just every dollar that ARK has gone down from 140 to 80 as we sit here just creates one more seller, one more person that can't stand it going down for another day or another point. This is CGM overlaid to ARK, and I just think it just looks very similar, right? Huge run up, big move, and then a bad break, although CGM's was really fast and swift due to the financial crisis. But this is pretty nasty. That's 50%. I think I calculated this move down for CGM at about 67% from high to low. And ARK is staring at roughly 50 some percent. We'll pull up the charts. So there's a good, it's not going to go to zero. There must be some value to the stocks that they're in. They're probably and were overvalued, but the odds are that they're a long period of sideways, which is what CGM, if you recall that chart. So let's go ahead and pull them up. Let's go live. So CGMFX, I think, is the ticker. Let's go to the monthly, and you can see the bad break, and then it just a lot of sideways action. And it still hasn't made a new high since 2008. If we go to something like Fidelity Contra, where did it peak in 2008? At roughly 4, and now it's 17. That's pretty good. Even something like T. Rowe Price New Horizons, 2008. Well, it peaked a little sooner, which is interesting. This is actually really interesting to me because it peaked much sooner than the overall market, kind of like a canary in the coal mine. But that is roughly 10, and it's 66. Incredible performance. But this is going to take me down a rabbit hole a little bit, and we'll get back to ARK. But T. Rowe Price this one is a great fund, and these guys do a really good job of finding new leaders early. Like I'd studied his buys, and like he would be a buyer of like Vive in here because he knew the business and knew it was fast growing and stuff like that. But, Ring Central, I don't know if Ring Central, does it still work? Yeah, I still exist in here. Like a buyer of really good companies in these long, big bases that Kathy Donnelly and Eve Bobeck and Kurt, their book, bear with me, it's been a long time since I read the book, but I believe they call it like the institutional due diligence phase, where they go public and then they go sideways for a really long time. So PRNHX is a really good fund to see that in his performance. And I think there's a new manager there too. So I apologize if it's not a man anymore. His or her performance really been like a canary in the coal mine for this sell-off. Been pretty tough for them. That's 23.5% off the highs, and they're really good. But let's go back to ARK. You're looking at 50%. And so, maybe it finds some type of floor, but probably based on history, this could be the peak for a long, long time. All right, so enough of that. I thought it would be interesting. I know it's on everybody's mind a lot. It's the poster. People like to. It's you get a lot of back and forth on on Kathy Wood and the innovation that ARK thinks about, and it's everybody is either, well, I don't say everybody, but it's always I don't think it needs to be all or none. I think they did a really good job of identifying some really great innovative companies. She was, let's be honest, she was right. She was correct about Tesla. They just don't have very good selling strategies, which is most mutual funds don't. It's very difficult to have a selling strategy. And even one person tweeted, in fairness to Kathy, they can't sell. Their mandate is to be all fully invested. What was she supposed to do? And that's the really hard part, right? So she's got to be fully invested. And these are the types of companies she believes in. So when the cycle changes, they're just not going to change. She's not going to be in there buying oil and gas stocks because she just doesn't believe in that, right? So, but the cycle right now is saying that that's where the money is flowing, and so that's why we look at industry groups. NASDAQ or S&P, it's so IBD has the uptrend under pressure, which is strange in regard to the overall market. I think it's an obvious correction / bear market. But in a vacuum, that what the big picture is looking at is just the indexes. So if I just woke up from a deep sleep for 9 months, and you showed me this chart, and you asked me to say what IBD, what would they have the uptrend under, what would what would they have the big picture at? I would say uptrend under pressure probably, and it wouldn't be wrong. So the indexes are holding up really well, which is the problem, right? They've really done a very good job of masking the weakness and everything else. Let's go to the NASDAQ. That looks a little worse, and to me, this area is super key that we're in right now. If we start living below some previous lows, then I think then the indexes are going to go into a bear market, and now the money could flow out of the Nvidias, the Teslas, the Apples of the world. And I don't think it's going to flow into the Teladocs and the Asanas and the Digital Oceans of the world. They might stop going down so much, but the money is probably, and you can see it in some stocks, I'll show you if you're going someplace else already. So the reason I highlight that area is because if you look back, here's a low, and you can't see what the market was doing previously, but we had this little correction. We did not make a new low, and then we resumed an uptrend. And then we made a low here, and then we had a tiny little correction, but we couldn't undercut that low either. And then we resumed the uptrend. And then we made another low, but it couldn't undercut that low either. And then we resumed the uptrend. Bear with me here on this. And then we made another low, higher low. You get the idea. Then we actually undercut a low here, 14,181. We not quite that undercut. It missed by $3, but we undercut that. But I'm going to draw it like right there. And you can see like how long did the undercut last? One closing day, maybe a couple of days right on there where it was, hit or miss. And then boom, huge back uptrend. So the NASDAQ just refuses to stay below any of these lower lows. And so you had a lower low here that you undercut, and it did exactly what it was supposed to do, what it's been doing for months and months and months. It rallied. But the rally in this case is much shorter than these other rallies. See the difference, right? So far, it's really very lackluster rally. And then you undercut those lows. Now that today you had attempted rally, market tried to make it another low. So this is day one of a potential follow through. Day 2, 3, 4. This was day 5. We were up, roughly 0.5%. It's not a follow through day by any means, but at least you've got some kind of, lower low, and maybe you can, I would love it to go sideways for a number of weeks. Forget all what I would love for it to do. The market never cares what I would do, but if we undercut that low, then we're back into another downtrend. So we're kind of in a a spot where, it's who knows which way it's going to go, but relative strength wise, pretty poor. Quickly, because I feel like I've been going on and on. Emerging markets, it's actually showing a little bit of relative strength. I wouldn't buy that per se, but I'm always, because the big money, at least the big institutional money, ex hedge funds, it's always being invested. It's just never going to the sidelines. So it's trying to find where it's treated best, and so it's looking for places. IWM, who knows? IWV, which is the value. I'm pretty certain that's value before I misspeak. Yes. No, that's the Russell 3000. I think it's the V stands for value, but anyways, holding up pretty good. Let's do this here. VTV, which is the Vanguard Value ETF. Nothing wrong with that. So you can see where kind of the market is holding up, where the money is going. Industry groups, let's go there. Oil and gas, Canadian, number one. Pardon me, 5 stocks. It's pretty small, but the sector. Building products, wood, interesting, only 4 stocks. Telecom, fiber optics, that's a high growth area, 9 stocks at least there's a number. That's third group. Coal, I think I've mentioned how I feel about coal. It's not interested in the coal. Semis, although they're down from 1, they're now 5. Semis are a really good group. It's probably the best area if the market heads back in, and I'm always open to that. I don't think that's going to happen, but it doesn't matter what I think. I'm open to that. In fact, I did buy a semiconductor stock today because it was just acting too strong. I couldn't help myself. So that group is really good. Auto is Tesla and Ford. Ford has a relative strength of 99. US Explorers, huge group, 56 stocks. There's lots of options in there. Number 7, and so on. So it looks like for me, the stocks that I've bought recently is semi and oil and gas. Very different. I can if NASDAQ's getting pounded, it's possible that my oil and gas stocks go up, and the semi I have goes down. And then vice versa. If it's a risk on, maybe they sell those, and the semi would participate. So that's kind of where the strength of the market is. Stocks to watch. Okay, so it's LRCX. It's Lam Research. So you can see today it just closed, but this is basically I think it's a lifetime high, and stock's never been higher. Weekly, coming out of this long base. Is this fabulous? It's not fabulous, but it's close enough. Semiconductor equipment. Taiwan Semi had a really good report coming out of this long base, and so that contributed to the strength. You can see Lam Research gave back all the gains yesterday, but then today spent most of the day just grinding higher. Relative strength line, new high basically. Let's see here. Maybe not close, but not quite there. So that's a name that's acting really well. In the oil sector, there's so many options. This is overseas, Norway, Equinor coming out of a base, LNG, oil and gas pipeline coming out of a base. I think OVV did that breakout today. Yeah. Oil and Gas International coming out of the base. RS line new high. APA broke out already. RS line new high. So you can see where the money is going. And you can also see where the money used to be. So C Limited, just nothing. It just can't get out of its own way. PayPal, great company, still use it. I use it the same amount down here when I own the stock, and the same amount here when I don't own the stock. It just can't get out of its own way. Look at how many pink bars. Like, it's just every bar is just pink. It's under distribution. And you really learn about overhead supply, because now you've got just like tons of shareholders that just own this stock and, the low to mid 200s, and that just creates a lid for it. What else did I want to go over? We always have to look at Tesla. It's not acting that bad to me. It's the last bastion. If they get Tesla, it'll probably be at the end of the bear market if they finally let this one throw up. So I watch it very close. I'm not in it hardly at all. I will trade it once in a while, both ways. Although my broker won't let me short it, so I have to do other other synthetics to short it. But I will buy it as well, because it's a great trading stock. If I feel like the market's going to rally, Tesla's probably going to rally. So I don't know. The jury's still out. If you bought it here, I think you need to stop yourself out. I think you're down 13%. It is what it is. Move on and try to find a different spot for it. Okay, so let's go to the quote of the week. Bill Miller: great investors are not unemotional, but are inversely emotional. They get worried when the market is up and feel good when everyone is worried. I think my experience and my thoughts on like being a robot, an unemotional investor, is not realistic. I just don't think, at least for me, that I can do it. So there's no way I can, be robotic and unemotional about losses or gains. I'm going to feel a bit exuberant when things are going good, and I'm going to feel awful when things are going bad. The main thing that I've learned to do, or not always, but most of the time, and I'm always thinking this, is recognize those emotions. So I recognize if I'm getting euphoric and excited about the gains, and therefore I know that it's probably long in the tooth and I need to take something off. Maybe I don't have to get completely out, because I'm not going to top ticket, but I want to recognize that, and I will reduce into that strength if I'm long. And if I'm short too, like if almost always, when I'm short in the market, like today, I came in short by being long, some inverse products like SARK, which is the reverse of the ARK, and QID, which is double inverse the QQQs. And honestly, I'm not big fans of these products, but it's the only way I can be short in a margin account. And you don't have to at me about options. I just refuse to trade options in my margin, in my IRAs. No, thank you. But I can buy those. And anytime I woke up this morning, market was bad, I get out. In fact, I'm even out before the market even opens. I'm out in the pre-market, because I am I feel excited. Yeah, wow, this is good. If for some reason, that's, especially on the short side, those profits are fleeting. So if the market just crumbles, unfortunately, I'm gonna be out on the open. I always look at the chart in the 87 crash and think I probably would have been short that Friday. But the unfortunate thing is I would have covered on the open on Black Monday. I'm 95% certain that I would have done. That's how I would have traded that. That would have been brutal to watch that thing keep going. But that's fine. I'll live with it. But so the main thing here is I like this quote. Bill Miller, if you're familiar with him, he runs his own money now, Miller Value Partners. He's knocked it out of the park on Amazon. He's been long Amazon like forever. He's a big Bitcoin bull. That's fine. Not for me, but that's fine. But he had a really great track record up until 2007, 2008. He had beat the S&P every year for like 15 years or something. And then he got crushed in the financial crisis. The market switched, and he'd be first to admit that he didn't switch with it. He was, buying all these stocks that he thought were good values, and they just kept getting worse. So, but he's turned it around and done really well. And I think guy has a lot of zeros behind his name, but I do like his thought process here. I agree with it wholeheartedly. So look around. If you feel like the markets, people are worried, then you want to be thinking about the potential for a move up. And the harder part is when they're, when they're feeling good, when stocks are moving up, it's hard to sell them because they often go higher. Most stocks I sell for a profit go higher. Like the vast majority of them go higher. It might be for a day or two or weeks, but sometimes, I sell them and look back and that was a terrible, terrible sell. But a lot of times I'll look back and say, wow, that turned out to be a pretty good sell, and why did I sell it? Just because, you got to sell when the going's good, like what Bill talks about in his book. Okay, everybody. Well, have a great weekend. I appreciate your patience. This one a little long-winded, but I thought there was some interesting things I want to talk about with like ARK, etc. We'll see you next week. Oh, it's a long weekend. That's right. Awesome. Markets are closed on Monday. Have a great long weekend, and we'll see you next Friday. Bye-bye.